I want to start this deep dive with an uncomfortable truth, a painful one actually, that most people entering the stock market just flat out refuse to see. You're putting your hard-earned money in, right? Sometimes you're risking your entire financial future. But are you truly investing? Or are you just playing the lottery? Because the numbers, I mean, they don't lie. 99% of people who jump into the market confuse genuine, disciplined investing with simple, adrenaline-fueled gambling. And that confusion, it's exactly why their capital just vanishes, or, at best, it just stagnates. So today we are cracking open the playbook for that other 1%, the ones who actually build lasting generational wealth. We're diving into the definitive text on this. Benjamin Graham's The Intelligent Investor. This is the book that Warren Buffett called, and I'm quoting here, by far the best book about investing ever written.
And our mission with this deep dive is really to give you a shortcut. This isn't about stock tips or tricks to get rich quick. It's a masterclass in the right mental framework. The true mansikta you need for any kind of sustained success. We're going to distill Graham's philosophy, which can be pretty dense, into practical, actionable steps. We'll use stories, analogies that, really resonate in an Indian context to turn this old theory into something you can use today.
Let's jump right in. We're going to give you 4 core pillars today. Okay, first things first. Before you even think about making your next purchase, you have to ask yourself this one question. Am I an investor or am I a speculator? A futkabaz. If you get this foundational question wrong, everything else just falls apart.
It's so crucial, and it seems simple, but it's deceptively so. An investor, you see, they take the long view. They buy a share because they are genuinely acquiring a small piece of a real business.
A real, living, breathing business.
Exactly. They're looking at its business model, its earning power, its potential for profit, its management. They see themselves as partners.
Right, so think of it like this. When an intelligent investor buys a share in, say, a big pharma company, they're not just buying a ticker symbol on a screen. They're buying a tiny stake in the R&D labs, the factories, the patents on the drugs that generate, predictable cash flow year after year. They're in it for the business, not the daily price.
And the speculator is the complete opposite. They ignore the business entirely. I mean, they couldn't care less if the company sells chewing gum or rocket fuel. Their sole focus is betting on price movement. Can I sell it for more tomorrow?
Or next week.
Or next week. Graham was very blunt about this. He called it akin to gambling. It's a game that is, in the long run, pretty much designed for you to lose.
And this brings us to a really relatable Indian micro story. Think about the mindset for high-stakes exams, like the JEE or NEET, the speculator. They have the mentality of someone buying a lottery ticket. Minimal study, hoping for a quick, miraculous win based on luck. A hot tip, maybe?
But the intelligent investor, their approach is that focused, quiet discipline of a student who's seriously prepping for the JEE. They understand the system. They put in the long, predictable hours of research. It's consistent effort to master the fundamentals for a long-term goal. It's all skill.
What's so fascinating, though, is the psychology of it. Why do so many of us default to speculating?
Well, because the market itself, with its flashing green and red screens, it encourages that short-term adrenaline rush. It makes the slow, disciplined research feel
Boring.
Exactly, boring. So you have to be honest with yourself right now. Ask yourself, do I spend more time researching a company's financial health or looking for patterns on the price chart? If you care more about the line on the graph than the balance sheet, then you're a speculator, and you need to redefine your approach now.
So if you only take one thing away from this first part, let it be this. Investing is a game of value. Speculation is a game of price. We have to shift our focus from timing the market to owning a business. Okay, so we've established we need to be investors. But how do we handle the daily chaos? The sheer volatility of the market. This is what drives most people to make really emotional decisions.
And Graham's analogy for this is, I think, his most powerful idea. He calls it Mr. Market.
I love this one. So imagine Mr. Market is your fictional business partner. Let's say he's highly unstable, but you have to deal with him. He visits you every single day. And based purely on his mood, he offers to either buy your shares from you or sell you his, at whatever price he decides.
And he's never subtle.
Never. So on his happy, greedy days, when the economy feels amazing and stocks only go up, Mr. Market is wildly optimistic. He's offering to buy your shares at these hugely inflated prices, maybe 3 times what they're actually worth. He's just driven by pure FOMO.
But then, just as violently, on his sad, fearful days, maybe during a market crash or some global crisis, he becomes completely desperate, pessimistic. And he's willing to dump his shares at rock-bottom prices, what we'd call panique d'âme, the price of water. He just wants out.
And here's the key. The intelligent investor's job is to use Mr. Market's mood swings, to profit from them, but to never be influenced by them.
You treat him like a useful servant, never your master.
Exactly. When he's terrified, you go shopping for bargains. When he's greedy and manic, you think about selling him what he so desperately wants.
But the tragedy is, most people do the complete opposite. They let Mr. Market's happiness infect them, so they buy high out of greed. And then, when Mr. Market panics and the price drops, they mimic him. They panic sell at a huge loss. They just hand over control to his emotions.
It's the emotional roller coaster of watching a close cricket match. You know, 1 minute Virat Kohli hits a six, you're celebrating, you're sure you're going to win. The next minute, a wicket falls, and you're just gripped by this absolute dread. You're ready to switch off the TV.
Yeah.
That is Mr. Market in your living room.
It is.
Or think about the local train analogy for panic selling. When the market dips, it's like everyone rushing to get off a crowded train at once. It's this irrational herd mentality, pushing, shoving, just to get out now. The intelligent investor is the one sitting calmly, waiting for the crowd to clear, because they know their destination.
And that's the critical point. If you see a market dip, you have to redefine it. It is not a crisis. It is Mr. Market offering you a sale. If a genuinely good company's price falls 20 or 30%, that's not a signal to panic. It's a signal to analyze, maybe even to buy more.
And here's a little hook for you. Have you ever felt this way in your own life? That stomach-lurching, irresistible pull to panic sell or to FOMO buy? That feeling, that is Mr. Market talking directly to your primal fear and greed. But it raises a really important question. How do you know if that sale price is truly a bargain? Or if the stock is cheap for a good reason, like the business is failing? This is exactly why Graham designed his next concept.
That uncertainty you just mentioned, that fear of being wrong, it is the single biggest psychological barrier. And Graham's solution is what he called the margin of safety, masses.
If you internalize nothing else today, get this is the bedrock. Think about it with an engineering analogy. If an engineer designs a bridge to handle, say, 10 tons of traffic, they don't build it to a 10-ton limit.
Of course not.
They build it to handle 30, maybe 40 tons, that extra capacity, that 20 or 30 tons. That is the margin of safety, is the buffer against the unknown.
And MOAS is the exact same thing in finance. It's the mechanism that protects you when your own estimates are a bit off. But to use it, you first have to calculate the company's intrinsic value, its real underlying worth, totally separate from Mr. Market's moods.
Right, and this is where it gets a little technical, but we don't need to turn into a textbook. You calculate this using things like the company's assets, its book value, its consistent profit, its earning power. So let's say after all your research, you calculate that the true worth of one share is 100 rupees.
The intelligent investor never buys at 100 rupees. That leaves zero room for error. Instead, they wait patiently for Mr. Market to have one of his bad days and drop the price to, say, 60 or 70 rupees. That 30 or 40 rupee difference, that is your margin of safety.
And this buffer does a few critical things. First, it protects your capital if, your intrinsic value calculation was a bit too optimistic. And second, it protects you from unforeseen disasters. A new regulation, a lawsuit, maybe even fraud. That MOAS is like a massive financial shield.
Graham understood that the future is, by its nature, unpredictable. We can research all we want, but we can't eliminate risk. The margin of safety ensures that the risk is asymmetric. You have a much bigger potential upside than downside simply because you bought it so cheap.
This idea, it resonates so deeply with the disciplined middle-class approach to life in India. It's the concept of jugaad, but in a really structured way. It's about ensuring survival. Think about having that emergency fund saved up, 6 months of expenses, or deciding to pay a little extra on your EMI each month just to build up that buffer against a job loss or a medical emergency. That's MAS in real life. It's not about maximizing your gains. It's about minimizing irreversible loss. So practical discipline number 3, before you buy anything, figure out its true value, its intrinsic value, and commit to only buying when the price gives you a big margin of safety. If this concept resonates with you, let us know and share it in the comments. It's a huge mental shift.
A lot of people read Graham and they panic. They think they need to quit their jobs and become full-time researchers. But Graham foresaw this, so he categorized investors based on their level of commitment.
Which is brilliant. He knew successful investing doesn't require everyone to be a professional analyst. He laid out 2 clear paths, and you have to honestly choose which one fits your life. So first, you have the defensive investor, the Rakshnamak investor. This person seeks good, steady returns without dedicating a huge amount of time or effort. Their main focus is on preserving their capital and avoiding big mistakes.
Right. They stick to diversification, they invest in large financially stable companies, blue chips, and they use systematic methods like SIPs or index funds, safety and smooth sailing.
The defensive investor basically accepts they don't have the time or skill to beat the market, so they aim to match it reliably. It's the sleep well at night strategy.
And then you have the other type, the enterprising investor, the udyogi. This person is willing to put in the time, 100 or more hours a year, doing meticulous research. They're seeking higher returns by finding overlooked companies or companies priced way, way below their intrinsic value.
This is deep value territory. It requires some serious skill.
It does. But the biggest danger is being a defensive investor who starts acting like an enterprising one out of greed. You know, the person who usually buys index funds suddenly trying to day trade penny stocks because they heard a hot tip. That is a recipe for disaster.
Think about it in terms of career paths in India. The defensive investor is like taking that steady, reliable corporate job. Fixed hours, predictable salary hikes. It's the blue chip stock of careers.
Steady returns.
Exactly. The enterprising investor, on the other hand, is like the entrepreneur starting a side business, a consultancy, a startup, maybe even a local chai tapri. They invest a huge amount of their own time and energy for potentially much higher, but also much riskier returns.
Both paths can work, but you have to know which path you are on and stick to its rules. If you're defensive, you have to accept you'll miss the occasional rocket ship stock. If you're enterprising, you have to accept the huge time commitment and, yes, the occasional deep loss.
So practical discipline number 4, be honest with yourself. Assess your commitment, your time, your knowledge, your tolerance for risk, and stick to your category.
Yeah.
Don't let FOMO pull you down a path you aren't equipped for.
So we've discussed these principles, and they were laid down, 70 or 80 years ago. Does this framework, built for stable industrial companies, still matter today amidst, crypto, tech stocks, AI fever?
Absolutely. I would argue it matters more than ever. Technology changes, sectors come and go,
Yep.
but human psychology, the raw forces of fear and greed, that does not change. Mr. Market is just as emotional and irrational today as he was 80 years ago, maybe even more so with 2047 news cycles.
That's right. Graham's principles aren't rigid formulas. They are a necessary mental framework, a manasik dhanacha that teaches you to detach from all that noise. It forces you to remember that when you buy a share, you're buying a piece of a living business, a halajanta vyapar.
So, to close the loop on our deep dive today, becoming an intelligent investor. It doesn't require a genius IQ. It doesn't require an economics degree. It requires 3 critical acts of discipline that we've outlined. First, the right mental framework. You have to separate yourself from the speculator and focus on the business value. Second, you need the ability to take advantage of Mr. Market's madness, not get swept away by it. And third, the unwavering discipline to apply a significant margin of safety to every single purchase you make.
That's the core of it.
And if you're ready to start applying these ideas today, right now, here is a concrete 3-step starter plan. It's based entirely on Graham's philosophy. Step 1, mute Mr. Market. Just stop checking prices every day. If you have to check, make it monthly or quarterly. Step 2, identify 3 large, stable companies that you genuinely understand, their business, their products, their history of making money. And step 3, commit to only buying shares in those companies if the price drops at least 30% below its recent high. This forces you to implement a margin of safety and buy when others are afraid. If this deep dive added real value to your thinking, if it gave you that manasik dhanacha, please like, comment, and share this with someone who really needs this discipline in their financial life. And now in the comments below, tell us within 1 minute, based on your life and your commitment right now, are you honestly a defensive or an enterprising investor? And what was your single biggest takeaway from the margin of safety concept? Thank you for joining us on this deep dive.